Hello traders, welcome to another weekly outlook for February 20th to February 26th. So right now we are just about half hour into the London session Monday. Today is going to be a quiet session due to the US holiday and Canada holiday. So really not too much liquidity going on. And let's get into what's about to happen this week. The first, let's recap last week. So last week, between the week of February 13th, February 19th, the biggest event last week were the testimony, basically testified from Janet Yellen in front of the Congress, and where she gave out a quite surprise hawkish tone, which was really not a usual stance for her, because usually Yellen is quite a more soft dovish. So last week she actually, quite hawkish mentioned about that they need to tighten the rate. It's basically saying it's unwise if they don't tighten the market faster, and that they are still maintain a forecast of 3 rate hikes for 2017. So of course that comment, along with consecutive of fundamental data, which continue to be very strong for US dollar. So these two factors really push the US dollar, especially if you see the futures market, that the implied volatility has increased largely for a March and May interest rate hike. So that was the biggest event last week. And of course, sentimentally, we have Donald Trump meeting with Canadian PM, Israel. Basically, as mentioned, the biggest risk sentiment for US dollar right now is the President Donald Trump himself. So right now the market is basically work like this. As long as he doesn't say anything or do anything too drastically, too negatively, then US dollar will revert back to its fundamental strength. So last week he was quite neutral in his stance. He did hold this unscheduled conference to talk about media, talk about Russians, but really nothing mentioned about the economy, or basically stop mentioning about currency manipulation either. So that was all pretty good, and there was still another push for this upcoming tax reform. And if you look at the US equity market, it really just keep making this higher high consecutively. And you look at the bond yield, also it's still in the high areas. So just understand that's basically what the market is, that fundamentally it's looking very well, but most traders or monies are still kind of afraid of this resentiment. And it is true for me, as personally as a trader, I still do feel a lot of pressure because of this uncertainty over the resentiment. And that's just basically how the market react. I do feel it's really nothing we have seen before. It's only February, but I think sentimentally, feeling wise, do feel like it's been quite a year already. But if you're looking at a calendar base, it's only not even the end of February. So it's a lot of up and down, especially psychologically for traders. A lot of people, especially for swing trader, I think if you're in, and it's really hard to find a direction. If you are on the other hand more like an intraday base, then you will and had a lot of good sentiment to write down. So that was what happened last week. Now this week is another light economic calendar week. Really, the end of February, we don't really have much major fundamental data this week. The only thing we have is the Federal Reserve minute, but even that shouldn't provide too much insight or volatility, because Yellen already came out last week, and that was the biggest push for Fed policy. So this week, really don't expect any fundamental catalyst. Sentimental wise, again, nobody knows what Donald Trump is going to do or say, so that we cannot predict for now. My current view for the market is all written here. Basically, nothing had changed too much. For euro, it's still a fundamentally bearish and sentimentally bearish currency. Last week, we did have new comment from Draghi, and basically, it just shows you another commitment for ECB to maintain the QE and to basically keep this low rate market. Also, Draghi says that the euro area outlook still remain to the downside, and the ECB Council is prepared to alter asset purchases if inflation becomes less favorable. So really, there's no upside for the fundamentally speaking. Sentimentally speaking, it's even worse because the French election, this volatility continue to be the main catalyst for Eurozone. And the poll, if you're looking at the current poll, it still shows a lead by Le Pen. So really, as we are approaching to March, I think the volatility will be even higher because of the French election. So that will, of course, pressure euro further to the downside. Now, we also have the GDP data recently was also not that positive to support euro. So that's why I think euro is still a fundamentally and sentimentally bearish currency. US dollar, as mentioned, really the contradiction, it really lies down to the fundamental strength and sentimental volatility. I wouldn't say sentimentally negative because you do have some positive push. For example, this tax reform plan that's about to come. But you also have a lot of sentimental risk. You have, this abolish of Obamacare. That means the domestic debt, treasury, the national debt might become even higher. And you have this kind of executive order, protectionism, a lot of public attacks by the president to other world leaders. All this is gonna create volatility that is not good for the market. So sentimentally, it's still neutral, but fundamentally, it's actually has never been this strong for the past couple of years. So that is really the only reason we are still very bullish about the US dollar. It's because fundamentally, we had not been in this kind of situation for the past few years. So it is if you're just looking at the data, it is a very, very nice picture for the US dollar. For Canadian dollar, still fundamentally bullish, also sentimentally bullish. Now, the OPEC is still a very large influence and catalyst for the oil market. Occasionally, you will have a lot of this kind of resentiment, ups and downs. You do have a large build-up from the U.S. shale producer. It's been, I think, the consecutive 3 weeks already. So that is something to drag down the oil market. But as I mentioned, these two producers from OPEC and U.S. shale producers are also a rivalry. So they will usually hate out each other. So at the end of the day, you have to see who has more influence overall. And OPEC members, especially Saudi Arabia, does have a large play in controlling the oil price. And I think really the main issue about the oil market is not this supply, it's really the demand, because the demand has been soft due to the global, the economy slows down. That is really the more fundamental reason that the oil price is not picking up. So the only thing you can rely on is the emerging market and also how the Chinese economy is doing. Now, so far, they are doing well, but as many of you know, they still have these debt issues that is looming over them. So if the government start to basically curb the market, then that's of course going to slow the manufacturing, slow the demand. That's going to hurt the oil market. And when that happens, you have to ask yourself whether this artificially supply curb can last. How long can it last? And most likely, when the economy is maintained artificially, it's not going to last too long. So that's why for me right now, I do think oil market is bullish, but only when it reach that $60 per barrel, which is what people are expecting. Then what's going to happen, nobody knows. I think it really will depend on how the global economy reacts at that time. So for me right now, unless we reach $60 per barrel, otherwise it's still looking upside. And on top of that, Canada does have a quite positive economic data. Previously, they have positive GDP, a pretty good labor market, and a pretty good inflation. They also removed this downside risk from NAFTA because the Monday meeting by Trudeau and Trump had been quite friendly as well. So, of course, NAFTA is still up in the air, but right now you will know that it's not going to be as harsh as the NAFTA between US and Mexico. So that is another good sentiment for Canadian dollar. But again, as a trader, I'm just giving you this as a weekly base because I wouldn't say that the Canadian dollar will be great, at the end of 2017, because I'm not even sure whether the oil price is going anywhere after $60 per barrel. So that's all we know right now, is that 60 is very likely to be reached, but what's going to happen after that, it's really depend on how the global demand for manufacturing and for the oil at that time. British pound is something that we changed this week. So the previous weeks we have this fundamental and sentimental, fundamental bearish but sentimental neutral. Now this week we had a new retail sales, and it's not only it's negative, it's like all retail sales year to year, month to month, both core and headline are all very negative. That means that in 2016, after the Brexit, the economists had predicted this to happen. And as I mentioned, sometimes the economies, or fundamentally you can be right in the overall direction, but you might be wrong on the timing. And that was what happened last year, that after the Brexit, the economists gave a lot of prediction that the UK is heading to recession. And not only that did not happen, UK actually finished up 2016 with a very positive fundamental data. But it doesn't mean their prediction was wrong. It just means their prediction was a little bit early. And this year, unfortunately for UK, this effect has slowly kicked in. Due to the depreciation of sterling, right now, all the goods become more expensive to discourage the consumption. And we already saw that happen the previous retail sale. And I was mentioned that if the retail sale continue to be weak, then it's really a trouble picture for UK. And that was what happened last week. And not only is negative, it was a negative surprise. So that means it's really outside the prediction. It's even to the downside. So right now, things are not looking well for UK. So economically speaking, it is really become an issue. Now, if this thing continue, they are really heading to recession. And if you're looking, you have, I think just Sunday we have the new housing data from UK, which is also lower than the expected number. So if this thing continue, then what's gonna happen is that people are not going to buy anything at all, even including a house, because nobody is sure about the future. And it's basically a very, very worrisome picture. If the currency keep dropping, goods become more expensive. Then, so again, right now, the future really depends on this negotiation. And the trouble is that no one knows when and how the negotiation is gonna pay out. So if the market continue to be hanging here up in the air, then the future is going to look to the downside, because no one will want to put their money into the UK right now for long-term perspective. And that will be a very negative picture for British pound. So right now, the British pound has become quite a negative currency for me because of all these reasons. Now this week, the Brexit bill is passing by to the House of Lords. Not going to have too much concept. We do see Tony Blair came out last week talking about, not having a Brexit. So there's still a little bit political drama from the Remain party, who just don't want the Brexit to happen. I think they will really work on more on that, because it is going to, as long as before the Article 50 trigger, everything is still irreversible, basically. So they are still trying the last bit of effort to basically basically ignore the referendums. And that alone, of course, is a sentimental catalyst. But I don't think it's going to happen. So if the triggering starts, then the whole thing starts. So for the outlook for UK, it's really kind of uncertain, and because of that, the currency is looking more to the downside. Now the new fundamental data also shows the weak part of UK. So that's what happened. That's the change for this week for British pound. For Australian dollar, it's still a fundamental neutral currency. As I mentioned, the only thing that backing it up is the central bank, the commodity price, and the Chinese economy. So these three things are very, very good to back up Australian dollar. But understand that these three things are highly speculative, because the commodity price has been supported, but it can very easily be pushed to the downside if we don't have that much speculations. The RBN has been a backbone for Aussie, but they have to explain if we continue to have a negative fundamental data. And that will happen on February 28th when the next GDP come out. So right now, the RBA has this, basically the only excuse for them is to saying that the GDP is going to pick up because the commodity price is also looking well. So if the next GDP come out as yet another negative data, then they will have trouble to explain their currency. They will have trouble basically to explain their rate. Then that the market will place more possibility for a rate cut. However, on the other hand, if that GDP come out as positive, then RBA will have more reason to explain their stance. So I think next week that GDP from Aussie is very important, because that will basically determine how the RBA is going to react to their future policy. So right now, fundamentally, Aussie is still neutral. It's not bullish because there's no data to support it. But sentimentally, it's very bullish. In fact, it's been the best performing currency so far this year. So as long as the high yield continues, the Chinese demand continues, the commodity price keeps going up, then Aussie is looking still to the upside for now. New Zealand dollar is on the same spot, but quite in the contrary, they are fundamentally bullish but sentimentally neutral. Now their sentiment has been pushed down by their central bank last week, but as I mentioned, things will always revert back to the fundamentals. So you already saw that New Zealand dollar did not drop further after the RBNZ jawboning it. So actually, on the contrary, a lot of New Zealand pair find its support. So at this time, you have to ask yourself, is there any more catalyst to push it down further? If we don't have that happen, then it will revert back to its fundamental, and the fundamental is looking to the upside for New Zealand dollar. So that's my personal stance as well. I think it's a fundamentally bullish currency. But since the central bank has this agenda to push it down, so that's something you have to watch out. For Japanese yen and Swiss franc, they both really no major news to change its stance. Both are still fundamentally bearish. Sentimentally, you have saw last Friday like how strong these two currencies can react to the market. Because if the market is really in a risk of sentiment, you will see this kind of huge movement, huge money inflow into the safe haven currency. And that's the time that a lot of traders got stopped out. So that's why I always say you have to be careful. If you understand, if you want to trade in a fundamental perspective, it's wiser to have a larger stop loss and to do in a more longer swing positions. Otherwise, you can always go with the flow. That means that even though Japanese yen, Swiss franc is a fundamentally bearish currency, you can always buy it during different sessions and just go with the flow. That will give you a better probabilities. Okay, so currently I don't have any new position entered, and my current position, of course, as many of you know, still in play. And really, this is really the moment that you just really depend on your own psychology, because it's not going anywhere, and there's a lot of risk sentimentally lies ahead of it. And I think for me recently, I think in this year or so, that's one of the reasons I kind of become more of an intraday trader, because I realize it's not even according to the performance or the result. It's really depending on my own psychology. I feel like holding a swing trade has become quite nervous for me, even over the weekend or over days. It's because the market is very volatile and unpredictable. It has been unpredictable all the time, but because of the new president, this 2017, I think things become really unstable, and sometimes it's hard to tell where it's gonna go. Because back then, it's more easier to see the general direction. But back then the only resentiment was the terrorist attack, and those things, as I mentioned, had a huge effect on the market on the first few incidents, and then people got used to it. And then the only another resentiment last year was the election and Brexit. So really, last what's driving the market was the poll. But even the poll last year, people had a quite strong agenda to the general direction. Before the Brexit, people thought that the Remain party is gonna win. Before the U.S. election, people thought that Hillary Clinton is gonna win. So what I'm trying to say is that there was a resentiment ups and down, but it's less volatile as what we have this year. Now this year it's really more on the edge, globally speaking, especially for the currency market. And that's why this year I found that holding the trade had become more pressure for me, psychologically speaking. Because every time over the weekend, I do feel like, man, I don't know what's gonna happen from the White House, and that just make me essentially still in the market, still trading psychologically, even though I'm not in the market. And that, of course, not really beneficial for me health-wise. So I will maybe adjust to see how I feel personally, because as I mentioned, I always put my psychology as the number one guidance, basically. So if I do feel this kind of psychological stress for holding this kind of swing trade, I will probably not doing any kind of swing trade for this year, at least for the first half year, unless we can understand how the foreign policy or how the U.S. president is going to react. Otherwise, I do feel the stress and the volatility is way much higher. So for me right now, a lot of things are in a drawdown, or maybe just back to the original entry point. So for dollar yen, basically all the trade are pretty much back to where I was. So it was, you got in here, going up a little bit, and now going down. Now you are really at a break-even point for dollar yen. Dollar Swiss, exactly same thing. Got in with a green candle, and now we are really back at the the break-even point. So for dollar trade, of course, I'm still holding it just because fundamentally the strength is still on my side. But as I mentioned, it's just a lot of volatility, sentimentally speaking. My Aussie trade, same thing. Aussie Swiss, last week was like huge volatility, huge downside without any fundamental reason. So it just shows you how volatile the market gets. Now, if you're looking at how do you know if it's a huge volatility, it's really not only by looking at the candle size. You gotta look at the average true range. So if you look at average range, it's about 50 to 60 pips. And last week you have 0.73 to 63. So last week you have about 100 pips. So that's basically like twice of the average range, without on the day that did not have any catalyst. So it just really shows you how volatile market is. So of course, we are still in the general upside, as I mentioned, and fundamentally it's still a favor on my side, so I'm still holding it, and same as Aussie yen, it's exactly same story. Fundamentally we're still looking to the upside, and we just still keep holding it. Same as Euro Aussie, same thing, huge retracement last week, but fundamentally it's still, I might look into the downside. Same as Aussie, compound Aussie, still looking to the downside, fundamentally speaking, and we just keep holding this kind of trade. So really, because we enter, because we enter all these trades fundamentally, so we don't change our position unless the fundamental have shifted. So that's why we're still holding it. And the things you have to be able to withhold this kind of sentimental noises. But that's what I'm trying to say, is that this kind of sentimental noises had become quite unpredictable to a point that I feel that I pretty much have to tolerate it psychologically. And it's just interesting because last year I feel even more okay in terms of these sudden terrorist attacks, and this year I feel like Donald Trump has even more volatility for the market than the terrorist incidents last year. So that's why I don't feel as comfortable holding swing trade, especially over the weekend. The other thing I have is my one of my the Aussie dollar swing the hourly trade. So this one I'm still in. Now I thought I'm gonna get stopped out way at here back then, but that did not happen. So I'm still in this trade. Again, I got in originally with a retracement here. So what happened is, after Janet Yellen's testify, dollar become very bullish, and for me, the reason to get in at that time was that because the dollar strength will push Aussie down, as Australian dollar had been very overbought, basically a very strong currency. As I mentioned, that I think Aussie is very strong sentimentally, but does not have enough fundamental data to support it. So basically, I think the market is getting ahead of itself. And now once the US dollar regain its strength, we should see Aussie being pressured down. So that was my reason to getting Aussie dollar. And if you're looking at Aussie dollar right now on a daily perspective, it's still looking to the upside. If you're looking at a weekly perspective, it actually is at its strong support. Strong resistance. So the strong resistance for Aussie is really right here, about 77.50. So that was the reason for me to basically, get into it, just because the dollar strength. Now, what did not work in my favor was that dollar did not react to Janet Yellen. So actually, dollar was being sold off regardless of the good fundamental, regardless of the good sentimentals, and that's why I was in a drawdown right after I got in, basically. So drawdown for the the rest of the week. Almost got stopped out because my stop loss is only 100 pips, 77.50. Didn't reach it, and basically now we continue to go down. So of course it's a good thing that now we continue to go up and down, and really as long as 77 can hold it, I will be more comfortable to hold this trade. Now I'm still in for the very simple reason that US dollar still had a fundamental bias than Australian dollar. It's still stronger fundamentally and sentimentally. But I'm not too confident about this trade, because originally this as an intraday trade, I really want it to get out. It's either get out or stop out, right, for me. But I don't like to hold this thing for too long. And now it's just really dragging out. So I really not comfortable holding it too long. But because I have a lot of Aussie long trade, so for me, another justification is just pure for a hedge purposes. So we'll see which one works out first. Either my swing trade got stopped out, but my intraday trade works, or the other way around. but I'll see what happened. The reason to hold it again is the fundamental perspective. So that's pretty much it. Nothing really changed in the fundamental perspective. And this week it's a very light economic week. Don't really have much going on. Let me pull up the Forex Factory. So this week, okay, you start with the PPI. Again, it's from New Zealand. It just happened Sunday. Another positive data from New Zealand, which again, supported my analysis fundamentally. Monday today, US holiday, bank holiday, really nothing happened here. You will have monetary policy minute. I don't think it's gonna create too much volatility. And Tuesday, you have an inflation report. This might give out more volatility, especially from last week's retail sale. So we don't know what's gonna happen. This might create some volatility over pound, but British pound still has this downside outlook. GDP price from New Zealand and RBA government speaks again. It's very interesting because next week is the GDP data, so it's really depending on how they want to prep the market. Basically, we got a second estimate GDP from British pound. It's not that important, honestly, because it's the second estimate, not a preliminary already. Core retail will be a good data to trade for Canada, just the intraday perspective. And then FOMC minute. This usually has a good momentum, but because of the taste fight by Jenny Yellen last week, this one is not going to create too much movement for this week. And then you have capital expenditures, not a tradable event, unemployment claim, a usual event, and then RBA government speaks again. So very interesting, it's gonna speak twice this week ahead of next week's GDP data, and then the CPI from Canada. So really, that's pretty much the data we have this week. Really nothing too fundamentally drastically gonna change. So really, I think this week will be another sentimental week, which is gonna follow the policy and follow the global progress. Just give me 1 second. Let me see what happened to last week's Canadian data. Was that manufacturing? That was okay. So that was prior to last week, 2 weeks ago. So 2 weeks ago for Canada, we had the employment. Okay, so yeah, so CPI this week, if we can have a good CPI, then Canadian dollar is already a very strong currency on our analysis. So if this week the CPI data can be a positive data, which the expectation was positive, then Canadian dollar is really going to become one of the favorite currency for us, because now you have a good GDP, a good labor market data. If the CPI can be positive, then you really complete the three major fundamental data. So we'll see what happens. It's still Friday, early to say. Otherwise, nothing much going on. You can still trade sentimentally, or just don't trade in this kind of thin liquidity. It's really up to your own strategies. So that's what I'm doing right now. For me, just really holding all my trades, keep monitoring, and understand my own psychological stance if I am able to. And for me, I don't like to fight my own psychology. This is one thing you have to remember. A lot of people get into the market trying to maybe push themselves to do things that they are really, it's good to push yourself out, to stretch yourself, but you don't want to do something that's really, polar opposite to who you are. So if you are a person who is very, very not able to hold a trade, then don't push yourself to do a monthly trade, right? You stretch too much, basically. So for me, I will see what happens, because it's only February in this year, but I already felt the differences of holding this trade for me, psychologically speaking. So if the effect is too large, then I'm going to refrain from doing too much swing trade myself personally. Let's take a look at our weekly trade. So again, for people who are not able to monitor the market, I think weekly is a very good strategy. You basically remove yourself out from this kind of sentimental turmoil. So take a look at Euro. The Euro pound, really, as you can tell, we have been a couple weeks of range bound, and that's basically fit into the fundamental picture because both currency are quite weak. Same as Euro Swiss, again very small range bound. Euro dollar is still looking to the downside, and last week we said that you can sell, and you did. If you sold it last week, you will get filled, and it's still looking to the downside to this 103 area. So if you are in, even though you do have this reversal signal, I don't think it's going to go back to 108. So Euro dollar is still looking well to the downside. Euro Aussie, if you have gotten previous week, you are really keep going lower. Now of course you have this reversal signal this week, and the reason is because you at this very strong support area. However, if you zoom out, you still have lots of room to go in the downside. So fundamentally, still a very strong bias for Australian dollar. It's still looking to the downside. Euro cash, same thing. We are looking to sell it. Don't have any signal. You also have this reversal signal for last week. Euro New Zealand also looking to the downside. And Euro Yen is not something we want to touch. For Pound Swiss, I don't want to touch it. Cable looking to short, and don't really have a signal, but this 1.27, 1.25 are all very good area to short it. Pound Aussie also looking to short. Again, we don't really have a signal. You have this signal a couple weeks ago, which if you're getting, it's a good one. You can keep holding it. And let me zoom out. Yeah, historically you still have a lot of room to go to the downside. And Pound CAD also in the range bound area, but this is we're also looking to short for this one. If you have gotten from this January 30 weekly, you can still hold it. Pound New Zealand also we're looking to short. If you got in with this candlestick, it's of course you are in the drawdown, but we do think it's gonna break to the downside for British pound. Pound yen is not something we want to touch. Swiss franc, Japanese yen also not something we want to touch. Dollar Swiss, we are maintain a bullish stance. It's a very strong bullish candle. Previous week, dollar yen, same thing. We are looking to long. And dollar CAD, it's not something we want to touch because they both are quite strong, both US dollar and Canadian dollar. So moving forward, Aussie Swiss is also something we're looking to long. If you have got in a couple of weeks ago, you will still, you keep going upside. Aussie dollar, it's not something I want to touch. Now, if you can have a bearish signal at this area, it's a very good area to short because as I mentioned, it's very, you see, you touch once already, 2, 3, 4 times, wouldn't able to break this 77.50. So Aussie dollar in a more swing weekly perspective, it is looking to the downside. Now, of course, if we break to 77.50, continue to go up on the accompanying of very weak US fundamentals, then it will change our analysis. But unless that happen, otherwise we're looking more to the downside. Now, next week, the GDP will tell a more clear picture for Australian dollar's direction. Now, Aussie CAD, on the other hand, not something we will touch. Same as Aussie New Zealand. Aussie New Zealand, it is looking to the upside, but it's just for a sentimental reason. So, knowing that you are facing this 100-day moving average, we don't know whether it can still keep going higher. Aussie yen, it's still looking to the upside. Aussie yen will be much better to long. I mean, even if you have a negative GDP from Australian, it's still gonna be a fundamental stronger currency than Japanese yen. And now you are above 100-day moving average. You are having this kind of bullish kangaroo tail. So it is a nice currency. I do think it will look into the upside. If you zoom out, the room is still a lot of room to go. So yeah, you could still get into this Aussie yen long trade, providing you have a big enough stop loss. Cash Swiss also looking to long. I don't have a signal here, and CAD yen I'm also looking to long. And now this is a nice kangaroo tail. Again, you could long this trade. If you zoom out, it's still looking a lot of room to go in the upside. New Z Swiss, New Z dollar. Now New Z, we are still very bullish about this currency. The only thing is that, you know, sometimes you have to again wait for the sentiment to pass. But New Z is still a good currency, especially, you know, versus New Z yen, New Z Swiss, also looking too long. So that's pretty much it. Because of the light economic data this week, I again do think the market is going to react most likely to the sentiment, both from the politics and the geopolitics. And that's something you have to watch out if you are a more swing or intraday trader. Now, if you are a weekly trader, as I mentioned, good thing is that you don't need to worry too much about the sentimental noises. Okay, so I hope this video is helpful. I'll be back later after New York session, next London session, to give you another daily analysis. Once again, it's a US holiday, so I think market is going to be very thin liquidity, especially later on when the New York session opens. Okay, so hopefully you will have a pretty good trading week, and I will see you in the next daily analysis. Thanks for watching. Bye bye.